Our market master joins us now, Vibhav Kapoor of IL&FS. Good morning, Vibhav. Good to have you with us. Perspective is really what we need at this point in time.
Thank you.
I mean, the markets are taking a breather at this point in time. Should one use this largely to buy?
Yeah, I think this is very clearly a buy on dips market, and every time you see the market going down or correcting a little bit, you have to be ready with your stocks, and it's not necessary that you go with the index. There are a lot of stocks which on dips are worth buying, so one needs to just buy these stocks whenever they correct and hold on for the medium term.
Okay. Vibhav, hi, morning. So what are these stocks or sectors that you would look at that still don't look too expensive at this juncture?
Well, very clearly it is the cyclicals, which means the financials, autos, and maybe some of the capital goods, although they might happen, they might appreciate at a later stage. But everything is linked to the economy, and as the economic growth hopefully picks up going into FY16, a lot of these sectors should perform well. Some of them might look overpriced in the short term, but I think this is a market where you have to buy and hold and look at a 12 to 15 month perspective, and then they won't look so expensive.
Yes, that is the point really. Let's start with financials, because that's about 30% of the market. When you looked at the private sector banks, they're all reaching out to all-time highs with each passing day, barring HDFC Bank, of course, where there is an intermittent news from the MSCI. But public sector banks, will you have the courage to buy them now? Because at the moment, the asset quality is still in a bottoming out stage. Nobody is giving you the confidence that this is the worst quarter.
Yeah, you're right. I think that was very well put, that do you have the courage to buy them, because you definitely need some courage to buy the PSU banks right now. Well, the results have been really bad, not even pretty bad, they've been really bad. We've seen a further increase in slippages, NPAs, restructured assets, everything. And therefore, you can call it a high risk, high reward sort of sector. But hopefully the market is banking on the fact that sooner or later interest rates will start coming down and the economic growth cycle will pick up. And that is the time when these problems which the PSU banks have will diminish. I don't think the problems are going to go away completely so soon, because you also have the added problem of capital. Most of these banks are now very much short of capital, so they'll come to the capital markets to raise money. But given the valuations and the fact that there is a positive probability of positive news flow going forward, I think at least the larger ones are worth looking at, and have some sort of allocation in your portfolio, if not too much.
What have you made of the flows that we've got in the last 5 to 10 days, Vibhav? It's been a constant 1,000 crores per day FI commitment. Do you see this trend continue until the end of the year?
I would think so. I think that's one really positive part of the market right now, apart from the Indian story, which itself is good and hopeful. You have a global scenario where there is so much of liquidity sloshing around, and this in spite of the fact that the US Fed is now finished its quantitative easing, but then you had the Bank of Japan going in with a big increase in quantitative easing just 2 or 3 days ago, and the ECB also is expected to do that sooner or later, and interest rates globally are really low. So I think in these circumstances you will see money flows continuing into the emerging markets, and more particularly into India. So I think that's really one positive aspect of the market at this point of time.
Regardless of where the markets have gone, the results, not just for PSU banks, but for a whole lot of consumption stocks, has been pretty bad. I mean, whether you look at Bata or Jubilant, Titan, things have not impressed with consumption, and the macro numbers are indicating much the same, whether you look at IIP or Core or what have you. How long will the run last? Do we still get a 9,000 by budget, and only then the skeptics will get the upper hand?
I think yes. We have a target of around 9,000 by end of this financial year. That's March. The market is actually, right in one sense that it is actually just banking on hope at this point of time. And, it's actually trying to discount FY16 rather than FY15 because it's well understood that, things are not so good at this point of time in terms of economic growth. We've had bad macro numbers and demand is really not picked up. But the hope is that with inflation coming down, oil prices coming down, so the macros are showing signs of improvement, although they are not yet reflecting in the numbers. But going forward, that will happen, and that will hopefully induce the RBI to start cutting rates sooner or later, which in turn will then cause a pickup in the economy and demand all around. And therefore, FY16 numbers should be far better than what they are in FY15, and that's what the market is hoping for. So I think it will keep on with this hope at least till the end of this financial year, or at least till the budget.
Okay. Well, let's continue with that theme of earnings. We have a query that's been posted on our Money Control message board. Varsha Singh has written to us from Mumbai, and she wants to know, post this earnings season, what is that one sector that you are now bullish on? I heard you mention, financials, autos, etc. But what has been your pick of the lot this earnings season?
Well, as far as the earnings season is concerned, as Lata rightly put it, it's not been a terrifically great season in most of the sectors. Some of the sectors have done reasonably well. But I think, as I was saying, it's not this earnings season which you should be really looking at. You have to be looking at FY16. And given what we've been talking about of a hope of improving macros, I think the financials definitely look to be the best. Now there are, if you don't want to be in the PSU banks in a big way, I think private sector banks still look good, although they are expensive in the short term. And there are a lot of NBFCs like housing companies which can really do well going forward.
Okay. Some news coming on some approval for DRL for Dr. Reddy's. I will not risk reading that name. So some unpronounceable drug has got permission, but we will keep you posted on whether it makes a seminal difference to the P&L. In a minute, we should get more details from Ekta, who tracks these stocks very closely. Vibhav, what should be the mix of stocks from here on sectorally? Should it be, once again persisting with public sector banks? How would you distribute 100 rupees sectorally speaking?
I would say it should have about 25 to 30% in the overall financial sector, which includes public sector banks, private sector banks, NBFCs, housing finance companies, and so on and so forth. Maybe another 10% in autos, another 15-20% at least in other cyclical stocks. And then you can have a little bit of layering of IT, for example. That sector probably should at least be a market performer. And a little bit in capital goods stock, because that sector will do well, but it's always a late starter because the capital spending will take some time to pick up. So one can have some exposure to that sector as well.
Okay. Just wanted to, bring your attention, Vibhav, to some news flow that we're getting right now with respect to Dr. Reddy's. It could be the biggest beneficiary of, this Ranbaxy's forfeiture that just came overnight from the US FDA. How would you approach the pharmaceutical space now? Because there's so much information, and some of these stocks get hit really hard, the ones like Ranbaxy, etc., post the news flow.
For once, break your self-given rule and give us some stocks.
Yeah, no, that's something which is a bit difficult for me to do. But, pharma sector, I always take it, break it up company-wise, because that sector is a sector where different companies have completely different business models. You have the generic model, you have the domestic model, you have the R&D model. So they're different models. So you have to be stock specific in the pharma sector rather than taking the pharma sector as a whole. And I think some of the larger companies in that sector have been really doing extremely well, particularly in the generic space in the US. And we have examples of Dr. Reddy and Lupin, for example. And of course, Sun Pharma. And I think that sector will continue to do well. And while stocks have really run up a lot, I think it will at least be a market performer going forward.
All right. Finally, we were talking about the mid-cap index with Udayan, and some time back he had boldly said that I expect 20,000 and I expect that is the NSE Mid-Cap Index to touch 20,000. And the gains in mid-caps will be double that in the Sensex and the Nifty. What's your sense? Do you think we're going to see a continued major outperformance of mid-caps?
See, actually, while the mid-caps have performed, but they started from a very, very low base. So, they'd been so much down and out that getting, the first 100, 200, 300% gains is not a great thing. It's after that once the valuations start to become reasonable, from there on, then the gains start to get muted. You need to be again stock specific and sector specific. I mean, while people do talk about the mid caps as a whole, I think you need to be very stock specific as far as mid caps are concerned. But generally, mid caps will perform well once the economy really starts to pick up.
All right, Vibhav, we leave it at that. Thanks for joining us. You have a great weekend. We'll see you again later on. That's the word coming in from IL&FS. They continue to stick to their 9,000 target on the Nifty.